The Wealthy Life is brought to you by investment dealer Raymond James. Life well planned. See what a Raymond James advisor can do for you.
With us today is mortgage consultant Jodie Kristian. We're going to learn how to get the best mortgage possible. Jodie, welcome to the show.
Thank you. It's nice to be here.
Even though you woke up this morning with a bit of laryngitis.
Yes, my apologies for my scratchy voice.
That's
nice
okay.
To be here, though.
We'll still get all the good content out of you.
For sure.
So tell me a little bit about your background. How did you get into the mortgage business?
Well, I got my degree in sociology with the intent of working in the social work field. And it didn't really pay me enough to pay the rent. So I decided to supplement my income by working at different law firms that were very real estate focused. I worked in the conveyancing department putting together mortgages and eventually just decided to get my mortgage broker's license.
Oh, and are you loving it?
I'm loving it. Yes, that was over 18 years ago and it's been a really good career.
So after 18 years in the business, I think you know a thing or two about getting a good mortgage.
I would hope so.
So the rules are always changing. What do people need to know today? What has changed recently?
Well, in the last year, and specifically in the fall of 2016, the federal government changed the rules for qualifying. They implemented what is called a stress test. That stress test applies to anybody buying a home with less than 20% down. If you have less than 20% down, you have to qualify at the Bank of Canada's 5-year posted rate, which is just about double the actual rate you would pay in the market today.
Oh, that's a great safety net. So by qualifying for a mortgage at a higher rate, it means that the amount you can borrow is less, essentially.
It's about 20 to 30% less.
So
it's significant.
Unless you have 20% down, you're just going to have to get used to that. And I think why that protection is important is if interest rates start going up, we don't want to go through another 2008, 2009 crisis.
Totally.
We don't want to go through that again.
Totally. That is one of the reasons. Another reason is that the federal government has looked at the way housing has increased across Canada over the last 2 years, and they're concerned that we may have a housing bubble. And so they're trying to slow housing down by making it harder to qualify for mortgages. I mean, let's face it, these are ultra low rates. And if you're qualifying at 2.5%, you qualify for a whole lot more mortgage money than if you're qualifying at just about 5%.
And housing prices change over time. They go up and down. We get into bubbles. We get into low periods. Interest rates change over time. When people are deciding how much they can afford, I think it's a very good idea. Pretend rates are way higher than they are today. Make sure you can still afford the payments and not get kicked out of your house. Totally. That would be terrible. Yeah. How about amortization periods? How long can people amortize their mortgage for?
You can amortize a mortgage up to 35 years today. Most banks are 30 years as long as you have 20% down, and we still have a couple of lenders that are going 35 years. You still have to qualify on a 30-year amortization, but we do have the option of going up to 35 years.
Now, a longer amortization period makes sense in some cases, and in others it doesn't. I mean, if you're young and you're just getting into the market and you're not going to retire for 35 years and your goal is to pay off your house when you retire, that's fine. The other time I see it handy is when people are retired and they're looking for extra income in retirement and they maybe still have a mortgage. Rather than worrying about paying it off so quick, amortize it over a longer period, invest the difference, and then you've got some extra cash flow.
Exactly. We help out a lot of homeowners that have a ton of equity in their home, but because the housing is so expensive here, or maybe they help their children through university, they're still carrying a small mortgage. And because their retirement income, they have other uses for it, or maybe their retirement income is quite low, they want to either pay interest only, which is an option,
yes,
or they can extend the amortization to 30 or 35 years. It's very helpful for some families.
What do first-time home buyers need to know?
I think first-time home buyers first and foremost need to know what they're pre-approved for and what the costs of going into a mortgage are. Not just the cost of the mortgage, but your property taxes, your heating costs. They should know legal fees, And
maintenance. I mean, when you're
Absolutely.
a homeowner, you know, you need something fixed. You can't just call the landlord anymore.
Totally. They should have a slush fund that they can dip into in case something goes wrong with the house.
How much do they need to put down?
The minimum down payment for first-time home buyers or any type of home buyer that is going to own or occupy the home
Yes.
is 5% of the purchase price, up to a purchase price of $500,000. If your purchase price exceeds $500,000, the down payment must be 10% of any increase.
Wow, so they're really, I don't remember that from 20 years ago when I
Yeah,
bought
that
my
changed
home.
in the last year.
Now, if you only put 5% down on a house, then you need CMHC insurance. I believe if it's anything under, is it 20%?
Correct, yes.
So CMHC insurance, if I only put 5% down, how much is that going to cost me?
It's 4% of your mortgage, and that insurance premium is added onto your mortgage. So essentially, once you add the premium on, and you're only putting 5% down, you're almost mortgage rate for the maximum price.
Yeah, you've got a whopping 1% equity in your home when you get started, even though you put 5% down.
Definitely. If you can afford to put 10% down, the premium drops by about 1%, and it continues to drop as you put more and more down, to the point that if you put 20% down, there is no premium.
Okay, now you know what? Something else that gets to me is people are always chasing the lowest rate. Is the lowest rate always the best thing to go for?
You know what? Rate is really important. Having said that, it's not always the best thing to go for. You need to know that some of the ultra low rates out there come with what we call a no-frills mortgage. And that basically means that you may have very limited prepayment privileges.
Yes.
The penalty to get out before the end of the term could be something like 3% of the balance of the mortgage.
Wow, that could be substantial.
As opposed to paying interest only, or 3-month simple interest to get out of a mortgage. And some lenders even restrict whether or not you can pay out that mortgage at all unless they sell the home.
Okay, so you need to think about this, and you need to know all your facts before you sign on the dotted line. I know a friend of mine had a mortgage and wasn't planning on moving for 5 years, but ended up selling the house because she saw something she liked better. Her mortgage didn't have all the right provisions in it, so she couldn't port it with her. She couldn't transfer it over to her new property. So she had to pay thousands of dollars in fees, and the cost and fees way exceeded any slight interest savings on the rate.
Yeah, you really need to watch out for that. And that's why it's so important to work with someone, a banker or a mortgage specialist that you trust, to give you, all the ins and outs, and go over the fine print with you. Don't just look at the fine print. It goes, in one ear and out the other. Ask questions, ask tons of questions.
So make sure you know everything you need to know, and hopefully, thank you for this. This has been very helpful, but hopefully people will know that before they sign. And if you want to know how much you can qualify for or how much your payments will be, go to thewealthylife.com, send us an email, and we'll send you a link to the calculators. Jodie, thank you so much for being on the show today.
Thank you very much for having me. It's been a pleasure.
And when we return, find out how RIF withdrawals impact your tax rate.